My name's Josh Brent, CEO and founder of Insellerate. I got a good friend of mine, Rob Chrisman, here with us. Rob, how you doing today?
I'm doing well. Thanks for asking.
And where are you today? Last time you were in your cabin. I don't think it looks like the cabin today.
I am in right now at this moment. I'm in San Rafael, California, just north of San Francisco.
All right, Northern California person. Nice area. Thanks for coming, everyone. Wanted to just discuss kind of market updates. This is the third one Rob and I have done since the market really changed in March, and kind of go over where the market's at, how the capital markets are moving. Obviously, Rob has great insight with his blog and the lenders he works with, and his experience in the industry. So before I do that, though, I'm going to give a quick shameless plug for Insellerate. For those who don't know who Insellerate is or what Insellerate does, ultimately, we're in the business of helping lenders close more loans. That's our business. We do it for a lot of lenders, large lenders, small lenders, banks, credit unions, mid-sized, large brokers as well. And we serve that with two core products. And we're the only technology provider in the industry right now that actually provide both of these products. We provide CRM lead management and also engagement. Lead management is lead distribution, click the call routing, inbound call routing, telephony integrations, plus engagement, which is going to be our ability to email, text message, to ringless voicemail, Facebook posts, direct mail, phone calls, Google AdWords, all custom audience targeted through our platform. So we provide content strategy, plus the actual system and CRM, and also stay tuned for an announcement, and you can see it on the screen. We'll be bringing out and launching mobile and bringing them to the market and showing for the first time in August. Definitely we're in the business of helping lenders close more loans. And from that, I'll start talking to Rob about where the market's at. Just from a 50,000 foot view, Rob, what has changed in the market in the last 90 days? What's the same? What's any upcoming issues? What are you seeing out there?
Well, Josh, thanks for having me today. We've gone in the last 30 or 60 days or 90 days, actually not so much 30 days, but 60 or 90 days, you might recall. I think the first one of these, I was sitting in front of my pantry with all kinds of food behind me, stocked up for some kind of, pandemonium. And who knew then what we know now, where we are, not only in the world, but in our nation and in our business. And the fact of the matter is, we've gone from a kind of a crisis mode where we were back in mid-March and mid-April to more of a we're here to save the world kind of mode in the residential lending business, at least, because we are we are in a great place to help save so many people so much money over the next several months and years, and in a great place to help a lot of people buy homes that they might not have been able to afford some months ago before this started. So as opposed to where the industry was in 2008, 2010, where we were the GOAT, as it were, now we are viewed as a savior, as a great place to help a lot of consumers. And certainly rates are low, but so many lenders out there have so many good products that can help borrowers. So we're in a great spot. And from a 50,000 foot level, everyone, even from 50,000 feet, you can see every lender out there, their noses to the grindstone, and they've got oodles and oodles of deals that they're working on. Loan officers are working 7 days a week and helping borrowers. So it's actually, aside from the pandemic side of things, which is kind of like over there, our industry is doing very, very well, and is poised to do so into the foreseeable future.
Yeah, you're right. I mean, our industry has tended to be very counter-cyclical when it comes to the financial markets. And I think you make a good point, which is this industry does allow people to buy homes, right? One of the biggest single builders of wealth amongst Americans is buying a house, is buying real estate. And then right now, to that point of where loans are and rates are and saving money, I was looking at just to see where the market's changed, how it's moved, how drastically this is. I think from what I'm seeing from the 50,000 foot view is the market's growing. There's more demand than there is capacity that's out there. In 2018 and end of July, the Fannie Mae 2.5% coupon was at 92.38. This time last year in July, it was at 98.5. Right now, it's about 104, 40 basis points. That's over 1,200 basis points in 2 years. And those were low rates 2 years ago. So the reality is there's so many loans that can qualify for mortgage. I mean, I think the truth probably is any loan that qualifies based off of credit and property, probably there's savings in there for them. And if the Americans take advantage of that, will be a huge savings for America right now. I agree with you on that.
Yeah, I'm sure it'll come up again and again in the next 20 or 30 minutes that we're together. But you're right. A lot of people can save a lot of money out there, and a lot of people have, which leads right into the capacity question, right? You know, how much of the pig can we fit through the python in the shortest amount of time? And companies are having to make those decisions based on capacity, based on manpower, based on technology. And I'm sure Insellerate is right there in the thick of things, trying to help lenders do that to get all these loans through in a very short period of time, which won't be easy, and which we can't do necessarily as an industry. So if you think about where interest rates are, and you mentioned where they are, I mean, they're amazing. If you think about where they are now, we could easily see interest rates stay at these levels, maybe even go lower in terms of mortgage rates, you know, for the rest of 2020 into 2021. So we have time as an industry to get the pig through the python, as it were. My apologies to any vegetarians that are on the phone or watching, but the fact of the matter is we have ample time to do this. And of course, you want to go out from a marketing perspective and keep that pipeline built up. But you know, it's not like rates are going to go up in a month. You know, most people think that they won't, given where we are in terms of the virus. So we've got some time to play with these rates and pipelines.
Yeah, and I think one of the things to point out, and if you're still seeing the same, we're still seeing that there's I don't know if you call it the risk trade or capacity trade premium between like best efforts and mandatory of 150 basis points to 200 basis points or more. Meaning there's still very healthy or probably even record margins in these loans right now would be my guess. I don't know if you're seeing the same thing. So when rates, potentially if the Fannie Mae did lose price and there's still so much margin in these loans, I think that you're right, rates wouldn't really move much or anytime soon.
Yeah, certainly margin continues to be a factor. You know, the quickest way, you know, if you pull up to an intersection and there are 4 gas stations and every one is at $2.50 a gallon for regular unleaded, and the fourth, you know, Josh and Rob's gas station is at $3.50 a gallon, you know, we're not going to get any business. The quickest way to slow things off, to shut things off, is price, just like the quickest way to accelerate things is through price oftentimes. And so what companies are doing, whether you're the largest correspondent like Wells Fargo, for example, or AmeriHome, all the way down to a small regional player, the quickest, easiest thing to do is control capacity using margin. You know, if your underwriters are overwhelmed, if your originators are overwhelmed, you're going to raise your margins and then slow things down. And then when things return to normal, you know, you adjust the margin accordingly. So that's the big question mark out there. Is right now, so many companies are out there having record months and having record margins that there isn't a lot of room for. There isn't a lot of room in the day for somebody in capital markets to listen to an originator say, well, gee, can we do better by an eighth? Can we do better by a quarter? Because you know what, there are 5 deals they won't care about that eighth or that quarter. So margins are plush, volumes are plush, When things slow down, as what may happen eventually, or which will happen eventually, then the margins will compress, and theoretically, you could have a situation where mortgage-backed securities and treasuries aren't doing much of anything, but rate sheets are actually improving because companies are improving their margins or reducing their margins in order to be more competitive. So, like I said, we could be in really good rate territory from a mortgage perspective for quite some time.
Yeah. What with that being said, something that I've been looking at and talking to our lenders with is servicing values. What have you seen, or what's going on in servicing values? Are they coming back? Is there still negative values out there? What does that look like?
So, yeah, if you go back to March, where we had, there was a Thursday, I think Thursday the 19th, when the non-QM industry collapsed in one day because the investors got skittish, liquidity dried up, and then over the following weeks, we had a situation where there was a lot of confusion, and thrown into that because of forbearance was the value of servicing. Do you really want to own servicing, especially government servicing, if you are going to be having to make payments to investors to front that money and wait for money to come back to you from the government? And so the value of servicing really plummeted. That has come back significantly. It came back in May and into June. I don't think it's come back quite to where it was, because there is this forbearance uncertainty, which will take months and months and months to unfold. But for right now, at least, the value of servicing has improved, which is nice to see, which has also helped rate sheets. And if it continues to improve, that'll further help the rates that borrowers see in terms of potential refis or purchases. So yeah, I have seen it come back, not quite as much. And of course, you have the difference between Fannie and Freddie and government servicing. But the aggregators such as Wells and AmeriHome, PennyMac have come back in. They had backed out, and so there is some demand for servicing. Are you seeing the same thing out there?
Yeah, no, I'm hearing that it's not as much as it was, but that there's some servicing value coming down the line, right? People are paying for servicing, not as aggressively as they once were. And I've also been hearing that what you just said, your aggregators, Fannie Mae, PennyMac, AmeriHome, they're actually paying up more than the agencies are right now for the selling to the Fannie Mae window. So they're paying extra, and that's probably because they're valuing some servicing in there that otherwise people aren't getting right now.
Yeah, I would. The concern out there. Well, let's go back to where we were a couple months ago, when you could, in effect, put servicing on your books basically at no multiple at all. I think those companies that were able to do that, sell to the agencies, for example, and add servicing, keep their servicing, they made a very smart decision, because now that servicing is improved in value. The question that the industry has out there is, what will happen? Will those smaller companies who held on to their servicing, will they have a demand? Will they have a need for that cash? And if so, are they going to start to sell small blocks of servicing as we get into the third and fourth quarter of 2020? What will happen? Will companies hold on to that servicing, or will they start to sell it? And if they do start to sell it, what the value will be. But for right now, the companies that held on to servicing at the second half of March and April, May, they're looking very good right now.
Yeah, no, that's definitely. I've talked to some lenders who are getting into servicing, and that's when they started keeping the loans. They realized from a cash perspective, they weren't getting anything to sell the servicing, so they might as well try to retain it. And the reality is, you can take a copy off Countrywide's playbook, which is servicing's the macro hedge, right? So the minute rates go up, if you have own enough servicing, your servicing values go greatly up, and financially you're looking pretty. So we're seeing some lenders right now say, hey, if we can put servicing in the balance sheets, if we can, if we're not really losing much, or if I'm only making 0 or 20 basis points or some nominal number for servicing, it's probably worth the value to keep it now. And in 2 years from now, it's worth 150 basis points or 200. Now people start really paying up, because when the rates do rise, a 2.5% or 2.25% interest rate is probably going to have a pretty long life in the servicing for servicing value, it's going to be a good loan. I don't think we'll see it go below that again, or whatever that number winds up being. You mentioned non-QM. Now I've heard some rumors of the non-QM market turning positive, meaning some of the non-QM lenders are now actually able to get a positive bid for their the loans that they held, versus back when that market hit, it was scratch and dent. You're going to take a 50% haircut and huge losses. Now it's turned into an actual positive net gain. What have you heard? Are you seeing anything similar, or how that market's working?
Absolutely. I think the market's working much better than it was going back to mid-March when everything went to hell in a handbasket. The fact, we're constantly reminded that there are people out there who need to borrow money, and we are in an industry that wants to lend money. The question is, at what rate and what price do the two meet, and what kind of product? How can companies best help borrowers? And so you have borrowers out there who want to borrow, lenders who want to lend. The question is, if lenders lend, are there investors out there to own those loans, to either put them in their portfolio or for the lenders to securitize them and issue securities? And to your point, yes, the non-QM market has come back. Last month the CFPB released a proposal seeking input on changing the definition of what a non-QM loan is, away from debt to income, which I think everyone in the industry figured that probably wasn't the best metric for non-QM versus QM, to something else. And I think that was greeted by the industry. I know there were a lot of proponents for the changes that have been suggested. We'll wait and see how that plays out. But for now, the non-QM industry has come back. Those programs are coming back. You have certain selected investors who will buy those loans from brokers or correspondents. And of course, anytime you make a list, you leave somebody off. But Sprout is out there, Angel Oak is out there, some others that are out there, ACC promoting their products and trying to get the business in the door. And there are borrowers who do that. That said, I am seeing something which is a little bit of a not exactly a fly in the ointment, but something I think for lenders to think about. And that is, there are some lenders out there saying there's so much business. To your point earlier, I mean, there are trillions of dollars out there that are still outstanding that can benefit from a refinance. If they view the non-QM loan as something that is going to bog them down, for example, it's going to take more time and more effort, and gosh, it's going to take 2 weeks to do this and 2 weeks to do that or whatever. The typical originator, the typical company will focus more on FHA, VA, Fannie and Freddie, more the vanilla product than getting bogged down in something. So the question is, even if it's a non-QM loan, that can go, if it's a non-QM loan that can go smoothly, fine. But if it's a non-QM or any kind of loan where they get bogged down, or say a bond program, or say an ARM loan, or something that's a little bit not, square peg, round hole kind of situation, I think a lot of lenders will stay away from that and say, they'll refer that borrower to somebody else or do something else with it, because they've got so much business out there that they can get through their pipelines in a hurry. So, but in general, the non-QM security market is functioning again. There are investors out there, and it has come back. Are you seeing the same thing?
Yeah, that's what I've been seeing, is that there's some non-QM, and you're right, there are people who have been marketing that product out there, and I've been hearing some securitizations have actually taken place. What's interesting, what you said was, you're right. Right now, if you're a lender, the question is, what do you sell, right? To your point, do you want to get bogged down in a new product if you don't know how to sell a new product, when there's so much conventional or government loans out there that there's more business than we can possibly do as an industry, right? So what's the most effective, most efficient, and that's one of the things that we've been really working with our lenders with right now, is how to be as efficient and effective as you can in the marketplace. Because if you're dealing with current loans, past loans, prospects, I mean, you have a capacity issue, and unfortunately or fortunately, the capacity issue isn't really the volume number, it's the unit number, right? So you as a company, whether it's 1,000 loans and that's 500 million in volume, or 1,000 loans and that's 200 million in volume, that capacity tends to be the same based off of the units, not the volume. So really, how do lenders become as efficient as they possibly can, right? So that they're making sure that they are as high touch with their higher loan amounts, being as most efficient with their clients. If you can only call 100 clients in a day or a week, make sure you call the most valuable ones that are the most qualified, that are easiest to go through the platforms, to just be as hyper efficient. We're seeing a lot of that right now in the marketplaces. How do you just become hyper efficient? Make sure you're not wasting your time, with people that don't qualify or who maybe are a hard sell. We used to say in the industry, when times are like this, sometimes you get borrowers who are shopping around for a lender who say, yes, I'll help you. And they tell you, oh, by the way, I have a hole in my roof, but I'll get it fixed, between now and I close the loan. We're really advising lenders to have higher standards kind of up front and be more discriminating on, whose applications they take, and make sure they're really good qualified borrowers.
Yeah, I would, something else for people to think about, that we are constantly reminded of, unfortunately, that doesn't come up often enough, and I try to bring it up when I can, are our early payoff penalties. The lenders out there need to be very cognizant of where that loan was sold, if they've done it before, or where the borrower, who's servicing that loan, and make sure that their company doesn't get socked with early payoff penalties, which can be pretty onerous and really cut into overhead. So originators need to be aware of, yeah, they just did this loan 5.5 months ago, and the investor has a 6-month early payoff penalty period. So let's let that loan sit for a couple of weeks until that penalty period ends, and then we'll refinance it, because and this is a point I bring up often in my commentary, is there's no investor that wants to pay 104 or 105 for a loan or a pool of loans and have them refinance in 3 months and get back par.
Yeah.
So they paid 105 and they get back par, so they lose 5 points, plus that servicing income over time. It just doesn't make a lot of sense. So we realize as an industry that happens, and borrowers want to always get the best deal and lower their rates. But as an originator, it's important to remember that that penalty oftentimes exists out there and is an issue.
Yeah, you're right. That's has happened with as much refinances are going on. It also points out the importance of having some good data intelligence and data management, meaning staying connected with your borrower, knowing when the loan originally closed. Also, if they are going to do a new loan, you want to make sure that that new loan's with you, right? Black Knight had a stat that I think it was only 19% of consumers go back with their original lender, which is, that means lenders don't do this very well. They're losing 80% of their business to someone else the next time down the road. So having the ability to really stay in front of that borrower, making sure that if they were to refinance in 6 months or 5 months, you could have the conversation, say, hey, I can get you the new loan. Oh, by the way, let's close your loan on August 1st, and we'll waive the appraisal fee, or we'll give you a discount, because that way you're not paying the prepayment penalty. But having that intelligence, understand what's going on, again, just really making lenders really efficient with that, being hyper efficient with that. What do you see? Just what it kind of end with, you briefly touched on it, was regulation. The last time there was a financial crisis, as and you said it, the mortgage industry was looked at as the bad industry, or we were, people thought that we were the cause of this, which I'll debate and say that's not the case. But we got a bunch of regulation. It just came flying down the pipe, right? This is very different this time because it's not a financial difference, but what do you see with regulation? Or, potential elections are coming up. Do we see the CFPB getting stronger, getting weaker? What have you heard from regulations? Are banks getting more scrutiny right now, less scrutiny, or has it been the same? We know how much banks get scrutinized. Well, what does that look like today?
There's an election coming up.
Oh, so you almost forget, don't you, with all that's going on?
No, I'm already tired of the politicking that goes on, but
Yep.
the it's yeah, the election obviously will determine the party. The current thinking is that uh, uh, you know, Biden seems to be leading Trump. Some of the Senate races are close. You have people who are a lot smarter than I am talking about some kind of Democratic sweep for Congress and the presidency. That has its problems. Um, the Trump administration has been very pro-business and anti-regulatory, or has an anti-regulatory stance to it. That said, I think that if you talk to people who are in our industry who've been around a number of years, many of the things that the Consumer Finance Protection Bureau has done and other state organizations have done have been actually positive. You know, for example, we all thought the industry was going to come to an end with TRID. Well, the industry hasn't come to an end, and in fact, companies and individuals figure out a way to work with it. With regard to the election and the regulatory environment, yeah, we are in a regulated environment. Whether you're a bank or an independent mortgage bank or a non-bank, you have regulations, you have guidelines that are set out to protect the consumer against the things that were happening in 2006, 7, 8. You know, ability to repay. Shouldn't every borrower have be able to demonstrate the ability to repay? So the things that were implemented weren't necessarily terrible, onerous. We can't get around this. This is horrific kind of things. If the Democrats sweep, or if the Democrats come into power in November, out in January, things may start to change. The Supreme Court ruled, last or earlier this month or in June, made a ruling about the structure of the CFPB, which may or may not have a direct impact on things directly. I mean, it may impact the way the CFPB goes about its business, but really, I think the companies that I'm seeing, the good companies that are out there, still keep in mind that we're here for the borrower. They don't want to go astray of the current rules and regulations. So things may shift in 2021. We'll have to wait and see. But for now, I think everyone is once again so busy with their noses to the grindstone that they're just dealing with the rules and regulations that are out there. And so for now, at least, it's kind of steady as she goes.
No, that sounds all right. We're seeing something similar. It doesn't seem like regulations are getting stepped up.
Yeah.
It's definitely been a little bit less of it over the last several years. And we'll see how the election will definitely affect that. I'm sure we'll I guess it's in November, right? And we'll find out soon. Anything else, Rob, before we end here that you can that is on the marketplace, or something that the viewers would like to hear, or any good jokes from you? We had some requests, or anything more recent.
Tell a joke.
No, you, not me.
A dog walked into the saloon and said, "I'm looking for the guy who shot my paw." No, I can't think of any jokes. But I think, like I said earlier in the discussion, we're in a great position as an industry to help millions and millions and millions of people,
right.
Either refinance or with their purchases, and we're in a great spot right now. I mean, rates are low. Pipelines are full. Margins are good. I mean, we could look back at this and say this is the greatest time to be a residential lender in the history of residential lending. So it's things are pretty good out there. There's not a lot to complain about.
Yeah, I would agree with you, Rob. In the 21 years I've been in this industry, I've never seen it to be a better time to be a lender than right now, like just where the marketplace is. And also helping the consumers. You're absolutely right. If you really think about this industry, if you can save the average borrower $150 or $200 a month, that can be very life-changing for somebody. That allows them to send their kids to summer camp. to tutoring, to a basketball program, lets them retire, lets them take a vacation, lets them do something in the backyard, right? It becomes very impactful. And this is the industry that allows lenders or consumers to do that. So that's good. That's good. For all you lenders out there, realize we are doing good, right? And that's a big part of it. And as many borrowers we can help right now, the more good we can do. Rob, I appreciate for your time and having you on here again. And for lenders, if you want to find out more about how we can help you be hyper efficient, manage your customers better, build more customers for life, and understand what lead management and CRM and engagement is all about, please reach out to us. You can go to our website, Insellerate.com, schedule a time with our team members. We'd love to hear from you. Rob, always good talking to you, and have a good day. All right.
Thanks.